Good evening, everyone.
Good evening.
Hi, how are you? All good?
Yeah, we are fine.
Right. All getting ready for the exam?
1 week away.
1 week away, yes. Today is the Thursday. Exam will be next Friday, is it?
Next Friday.
Yeah, that's right.
Yeah. Good. All good. I can see Ranil, but I can't see anybody else. They've all switched off their video cams, I guess.
Yeah, that's right.
Good. So, guys, what we are going to do today, we will conduct this as a revision session. We've already had all our sessions back in Dubai, as well as 2 sessions in Colombo. So now I have uploaded about 6 past papers. I have sent it to Ranil, and Ranil has made arrangements to distribute the past papers across. So if you have had time to go through those past papers, I'm ready to take questions, give you clarifications. If you want to practice 1 or 2 questions online here with me, we could do so. And our final exam would be in a format which is quite close to these 6 papers what you saw. So let's make it an interactive session. I've already had 1 question from somebody from Dubai. I can't remember who asked that question. He asked me a question in relation to the apartments related project appraisal. So likewise, does anybody have specific questions on the past papers what I've uploaded?
I have a small question.
Can you tell me your name?
I'm Chandana.
Okay, yes, Chandana.
This may be a very silly question, but since I'm not
Nothing
from
is
a
a silly
financial
question.
background, now there are some, accounting and finance jargons in some of the P&Ls and balance sheets.
Okay.
So in that case, when we are going to do the valuation,
Right.
Sometimes it is, I felt little bit difficult for me to understand, which one to be included and which one to be excluded. That's the only challenge I face with that question so far.
Right. Can you tell me what kind of jargon are we looking at? Which paper? I have the same papers here in front of me. Which paper are you referring to?
One is the exam paper in December 2015, final revised. That is the file name I have.
Okay, right. I'm opening it now. Right. So let's go to. No, I couldn't share it. Right. Let's go to the. Which one are you referring to? The balance sheet or the P&L? So I now assume that all the participants all have these papers with them, either in electronic form or in the printed form. So when I have this conversation with Chandana, I assume that everybody else is also following this, so they also can learn something out of this. Right, Chandana, now are you looking at the balance sheet or the P&L?
The balance sheet.
Right. So in the balance sheet, where is the issue? What's your problem?
The problem is, like, for example, if something like deferred taxation kind of wordings, like in liabilities, do we include that in the calculation?
It's like this. Now, in the balance sheet related valuation, you need to take all assets into consideration, right?
Okay.
Whether they are current assets or non-current assets, you need to take everything into consideration.
Okay.
So you need to take, in this example, there are 1, 2, 3, 4, 5, 6, 7, 8 non-current assets. Yeah, are you with me? Can you count
Yeah.
and tell me that it's 8? Yeah. Is it 8 or is it
Yes.
7?
That's right. 8.
It's 8.
Yeah.
And then there are 1, 2, 3, 4, 5, 6, 7 current assets.
Yes.
Starting from inventories right down to cash.
Yes.
Now, when you value a business, all assets should be considered.
Okay.
But if there are specific notes to say certain assets have changed in their values, then you need to take that specific asset and change the value. Now,
Alright.
for example, here down in the notes, it says market value of property, plant and equipment is 40% more than the book value. So I go to the market value of property, plant and equipment for the
Okay.
company,
Alright.
and that gives me a value of 3,520,467. Are you with me?
Right. Yes.
So I adjust that by 40% up. Got it?
Okay. Okay.
So the value will go up by 40%. So I cut the 3520467.
Yes.
To that I add 3520467 plus 40%.
Understood.
Right. Then I come to the next asset. Now there are no notes given on the next asset, which is the intangible asset.
Okay.
So if there are no notes given, I take it as it is.
Alright.
Right? Now, if you come from a non-finance background, that's all right. If anything is listed under assets, no matter what funny name that is called as, you take it as an asset. All right?
Alright.
The only way you make a change there is if I have given anything underneath as notes, then you need to go there and adjust the value to suit my notes. Got it?
Got it.
Now here there is a bit of an accounting trick, which I think it's a reasonable trick. If you read the body of the question, it clearly says that this is John Keel's, I think. This is Colombo Cold Stores, which is Elephant House. Who's buying Elephant House, guys? I forgot. Who's buying who? Guys, who's buying who? Can you go to the question and tell me who is buying what?
Also buying KNJ marketing services.
CCS and indicator its willingness to sell the company. So
To whom? To whom?
Maliban business.
To Maliban Biscuits. So now Maliban is buying CCS, no? Maliban is buying the Elephant House. But somewhere in the notes, it is clearly said that when Elephant House is bought, the subsidiaries are not bought. Are you with me? The subsidiaries are not bought. Are you with me? Can all of you all find that clause in the question that subsidiaries are not bought?
Yeah, that's right.
Good.
Assume that Maliban Biscuit is planning to take over CCS without the subsidiary KG Marketing Services.
Absolutely. So then that investment in the subsidiary should be taken out. I don't think that is accounting, that is very common sense. What do you think, Chandan?
Absolutely correct, Fernand. I am wrong in that one.
Right. Got it. So I might adapt a small simple trick like that. But now let's come to your question. You said deferred tax asset. Should I take it or not take it? Now, you don't worry about the funny name it is called as. If it is listed under assets, you simply take it. Okay. And if I have given a note underneath asking you to change the value, you carefully read the note and change the value. Now let's go to the second note. The second note, it says, can we all read the second note? It says 5% of the inventories are not usable. Can we all read that? Everybody, 5% of the inventories are not usable. Right? Right. So Chandana, what are you going to do for inventories? How are you going to adjust this value? Tell me.
I will deduct 5% from that inventory's value under the company.
Absolutely. Does anybody else who doesn't come from a finance background has a problem with that? Where's our Chandana? Who is our IT guy?
Kirti.
Kirti, yes. Where's Kirti?
Lovely family, right?
Yeah. Where's Kirti?
Can you hear me?
Kirti, you are there? I don't think Kirti is logged in today.
Hello, can you hear me?
Yeah, I can hear you. Is that Kirti? Yeah. Kirti, were you following all this? What I explained to Chandana, were you following?
Yes.
Right. Do you understand this? Do you understand this or?
Yeah, for me, yeah.
Good. Then what happens? Then I adjust the inventories. Then it says trade and other receivables, which are the receivables, and they say some percentage of receivables cannot be collected, so you need to adjust that. So then I think those are the only adjustments, guys, as far as the assets are concerned. Let me quickly double check on that. Yes. And so you take the assets, the addition of all assets with those two adjustments. Then you come down to liabilities. The value of a company, as we studied in the class, is assets minus liabilities. So when you take assets minus liabilities, make sure you take only the current liabilities and non-current liabilities. You leave out the equity part of it. Equity is not considered. I think someone wrote to me with an email asking a specific question. So do not take equity. So here in this question, your liabilities are 1,014,787 and 1,509,265. Do not take the equity, because equity anyway belongs to the shareholders. No, so you don't have to take that in. But remember, out of that you need to adjust something by 70 million. Trade and other payables have to be adjusted by 70 million. So 645,002 will have to be adjusted by 70 million. Are we good with this, guys?
Yeah, good.
Yeah. Right. So that's good, Chandana. Anybody else has questions in relation to the paper, unclear areas, anything else?
Regarding the March 2015,
Okay, right. What is it about?
it is first one, which is the first question itself.
Hasa Usata, right. This is about apartments, right. Okay.
Only concern about the loan and the loan amount and the equity percentage and the discount factor.
Okay, so what's your question? How to work out the discounting factor?
Yeah. Actually, that
Right.
I prepared for like last 4 years, then took the initial investment and the expenses, variable investment, everything, and then the installment payment like a 20%, 40%, 30%, 10%, everything like a monthly down payment receivables and the payables. The same time again, I have only concern about this equity and loan. The
Right. Okay, now here we guys, everybody, we are on March 2015 paper. We are on the last bullet point. Right. Now in this last bullet point, it says company plans to finance 50% through a bank loan at an interest cost of 8% and the balance through the retained earnings of the company at a cost of 12%. So here we have a situation where we have used two tools to fund. So when we use two tools to fund, what is our average cost of funds? So basically you do a simple mathematics calculation, 50% of 8% plus 50% of 12% is your weighted average cost. So 50% of 8% is 4%, 50% or 12% is 6%. So 4 plus 6, your average cost of capital, which we call it the WACC, weighted average cost of capital, is 10%. Are you okay with that?
Yeah. Now I got it.
You got it?
Yeah.
So every question I will give you 2 tools or 3 tools, and you will have to multiply it by the percentages and calculate a weight average to understand what is the weighted average cost of capital, and that you will have to use the discounting factor tables to convert them into discounting factors. Remember guys, my paper is an open book exam, so you can carry any material into the exam hall. Got it? It's an open book exam, right? Even if you want to carry the whole library, you can. Only thing you can't carry are the notepads, iPads, phones, kind of stuff. You can't tell the invigilator, look here, all my notes are in the notepad, it's in the iPad, therefore you should allow me, මේ බලන්න මේක flight mode දාලා තියෙන්නේ, right? මේකෙන් communicate කරන්න බෑ, බය වෙන්න එපා, මේක flight mode තියෙන්නේ. No electronic gadgets are allowed, right? So I might not even give the discounting factor tables in the paper itself. So you will probably have to carry your own discounting factor tables in case if you want to quickly refer the discounting factors for the cost of capital. You can carry all your class notes. It's advised that you carry the book also. Ranil, did you get the book? Did you get the book? Yeah, that one. Yeah, that one. Yeah. I advise you to carry that book also, because sometimes depending on my mood, I might throw something from the book also. So that doesn't mean that you guys are going to read the book in the next 6 days. But just to be on the safe side, carry the book with you. So then there is a glossary එකක් තියෙනවා පිටිපස්සේ මොනාරි දන්නේ නැති දෙයක් තියෙනවා නම්, if something appears on the paper which you don't know, quickly you can go to the book and refer. You know, that is also a
He has not got
possibility.
the book. Everybody has not got the book.
Everybody has not got the book. Is that
Your mood will be
right.
okay.
Right. Okay, so then I will not test anything from the book. Right.
Scientific calculus also, please.
Yeah. Why you can't find scientific calculators?
Forgotten to operate it.
I have one more question.
Right. Who is
Now-
this?
I'm Chandana again.
Yes, Chandana.
Sorry, I'm throwing a lot of questions.
No, that's the purpose of today. No, Chandana, you are the one who works for the construction company, huh?
No, I'm working for Emirates Airlines.
Ah, right. Okay, right. Okay. All right.
In the same question paper that we discussed, it says that question number 2, if the construction cost increases to rupees 7,500 per square foot,
Okay.
what will be the NPV of the project? Now, in this case, are you expecting the same workout to be done separately and show it the method that you're expecting?
Well, you don't have to do the whole question right over again. Since you have already calculated the NPV, you know what the final NPV is. So what you can do is you can separately calculate the difference in the construction cost at 7,500 and do the discounting for that. And then check by how much should you adjust the original NPV if the cost comes down to 7,500. So you only have to do one calculation and adjust your NPV rather than redoing the whole NPV.
All right, got it.
Got it?
Thanks. Yes.
Good. What else, guys? Prasanga is not logged in today. Prasanga is not in today, right? Okay, what else, guys? What else? Did you guys get scared after you saw the paper, or were you comfortable? What are your first impressions?
Would say thank you very much for giving those papers. Actually, after doing those things, my confidence level has gone a bit up.
Good. Good. Anybody else? Questions? Any paper? Okay. So what I'm going to do now, I will take you through a paper and tell you how you should respond to the. Are there any questions? Good. How you should respond to the papers. So I will take. Can I take December 2014 paper? Can we all look at December 2014? Right. First of all, keep in mind that this paper is a compulsory paper. There are no choices, right? It's a do or die paper. So that's why under the instructions you say answer all questions, and then it clearly says this is an open book exam. So I will give very strict instructions to the invigilator not to block any of the students carrying books to the exam. But like I said earlier, no electronic devices. Yeah. Right. Now here it's about a cola company which I funnily call Penny Cola, who has a market share of 4%, who wants to introduce a new product called Enta, so which is named after this famous product Fanta. So we want to see how good Fanta is. So here now you are given various different details as to how to do this project appraisal, right? The project is for a period of 4 years. Then what? It will be sold in single variety, that everything would be sold in 500 milliliter PET bottles. It is estimated that during the first year of operation, 2 million bottles will be sold. So what you need to do is you need to calculate what is going to be the revenue. So revenue is going to be simply 2 million bottles into the third bullet or fourth bullet point says price per bottle is 120 rupees. Yeah. So your revenue is going to be 2 million into 120. That's about 240 million. So you will do a nice format because it says the project will be for a period of 4 years. So you will do a nice format like what we did in the class for the purchase of Nissan UD trucks. You will say year 1, year 2, year 3, year 4. These are going to be the revenue. First year it's going to be 240 million. Second year sales are going to go up by 10%. So 10% extra sales, 120 rupees per bottle. And somewhere in the question it says price will be maintained throughout at a fixed level. But then you need to be careful. In the fourth bullet point it says 20 rupees of this money should be offered to the distributing agent. So your real net revenue is 100. So you can either show this as net revenue, which you multiply everything by 100, or you show 120 and deduct 20 rupees as distributor margin. So that way. And then you need water, and then water is going to cost you 40 rupees, and then it's going to increase 5% every year from the year 2 onwards. So your first 2 years water is fixed, but after that third year, year 2 onwards. Year 2 onwards means you have to take second year as well for the increase, and then every year it goes up by 5%. Then what? Then essences is 10 rupees per bottle. Then you need to pack this in plastic bottle, which is 15 rupees, sorry. Then you need to take other production costs, which is 10 million per year. So you need to put 10 million for the first year, and then increasing 10% for the second, third, fourth year. Then plant and machinery, you need to buy immediately. Always immediately means year 0. Immediately means year 0. So 120 million should be recorded as a cash outflow for year 0. And then at the end of the fourth year, you are going to sell this machinery for 20 million, and that should be recorded as a cash inflow. So 120 out, 20 in. that could probably be shown in a nice line called investment. So under investment, year 0, 120,000, year 4, 20,000. Now then depreciation. Depreciation need to be refined from the overheads. Now if you look at the last bullet point, it says the overheads are 50 million, but including depreciation. Now it's quite clear that we do not take any accounting payments into NPV cash flow, because NPV is purely a cash tool. So if there is any depreciation, you need to take the depreciation out. So how do we calculate depreciation? Plant and machinery 120 in, 20 out, meaning for the period of 4 years, as a company you have lost 100 million. How did I calculate 100 million? 120 is what you spend, 20 is what you finally get. So you have lost 100 million. 100 million over 4 years, for a year you are losing 25 million. 100 million over 4 years, for a year you are losing 25 million. So out of your overheads of 50 million, 25 million is depreciation. So take that out. So your overheads should be recorded only as 25 million, which is the value without the depreciation. Yeah, don't do this mistake. Anybody has questions on that little explanation? All good? Yeah, and then obviously I will ask you all to calculate the NPV. Along with that, I will ask you to calculate probably payback period. Payback period will have to be calculated to the closest day, which we did in the class, so refer those notes. Then I might ask you to calculate the IRR. When you calculate the IRR, I will give you another point. I will say if the NPV, if the cost of capital is like 20% or 30%, the NPV is going to be this. And then after I test you heavily on NPV, payback, IRR, then I will ask you, what is your decision? What are the non-financial factors you should consider before the final decision? Now here one key non-financial factor in this question which I expect from you is that they are a very small player, 4%. So definitely they are not the market leaders. So if you are very small in the market, like 4%, can you really be successful by launching another new product? Or should you consolidate? So likewise, you need to come up with some mature MBA related, arguments. Because this is an MBA exam, so this is not like a small bachelor's exam. So I expect solid MBA related arguments. Yeah. Good. Anything in relation to question number 1? And the question number 1 will technically be about 30 marks ish. Anybody has questions on question 1? Good. Then question 2 is about a takeover, and a takeover would be a well-known takeover. These are all fictitious. These are all created. Now you would see this is a lovely takeover. Lucky Yogurt is being bought over by Unilever. So immediately you see some connections. What are the connections you see? Unilever is a company which sells so many different products, but they do not have what? They do not have yogurt in their portfolio. So it looks like they are trying to buy Lucky Yogurt to cover that gap. So in your 6 fits, question 2, there will definitely be a 6 fits. So you need to talk about this as either a strategic fit or a marketing fit. Then what could be a misfit here? Lucky Yogurt is a homegrown company. It's a single entrepreneur who started its business very small in his backyard, from the south of the country, very traditional, but now him being taken over by a multinational company. Will the cultures match? Will the operational practices match? Will there be clashes? Can Unilever sustain? So these are the interesting discussions you need to have in your 6 fits. Question number 2, the first question itself will be the 6 fits. Yeah. And then I'm giving you a P&L. So you need to go to the P&L, do the EBITDA, earnings before interest, tax, depreciation and amortization, multiply it by the P ratio and get the EBITDA calculation. Yeah. Then you need to do the balance sheet valuation. And then I'm going to give you a number and say Lucky Yogurt has said that they are going to bid at 4.2 billion. Are you buying this or you are not buying this? So you need to clearly say whether you buy or don't buy. And from where do you decide whether to buy or not? By the 6 fits and the valuations. The 6 fits and the valuations. Yeah, so that's like the question number 2, which takes about another 30 marks. So by this time you have answered now 60 marks.
65.
Yeah, 60. Maybe in the paper what you all are getting, it will be 30-30. Yeah, it will be 30-30. So by this time, you must have finished about 2 hours of the exam. Now, one of the most common fundamental mistakes I see in the answer scripts is overspending time on question number 1 and question number 2. Remember, question number 3 and question number 4 also are equally important. So if from a timing perspective, guys, you must spend 1 hour for the first question and 1 hour for the second question. And by the time you come for the third and the fourth question, you should have 1 hour left to do the third and the fourth. This is a 3-hour exam. Yeah. Third question.
Sorry. Just a small question again. There be a major difference from those 2 valuations, the final answer, like PE valuation and the asset valuation. Would there be a major difference?
There can be a major difference between the 2 values. Even in our classroom question, there was quite a significant difference. So don't worry if you get a seriously different valuation by the 2 methods. It's normal.
In that case, like what should be our argument with the offer that you are going to give?
Well, you need to understand whether this is an asset-rich company or this is an asset-light company. Okay. If it's an asset-rich company, then you need to do your valuation based on the balance sheets, and your valuation should be more favored or inclined towards the balance sheet valuations. If it is an asset-light company, then your valuation should be more closer and inclined towards the EBITDA valuations.
Understood. Thanks.
Coming to question 3, question 3 will all, that is one page, one side is 1, the same page reverse side is 2, and the next page half, 2.5 pages. Yeah. But remember, you only have to pick one topic out of the 4, not all 4. Then question 4, in this example it's forex, but it need not necessarily be forex, it could be anything. So don't come ready for a forex question and then say that I didn't give the question what you expected. 4th question can change to any topic, right? Only in this question it is forex. So here we have, like, I'm asking you to calculate some cross rates for like what we did in the class. What else? And then I'm asking you to calculate the forward rates using interest parity theory. Is it interest? No, inflation parity theory. And then I'm asking you how to do forwards, how do you manage the risk, and so on. Yeah.
So what else could it be?
There could be what? Like our first question, globalization of finance. It could be. It could be. What else? It could be. Did I do dividend policy for you?
No.
Right. Then it could be on working capital management. It could be on financing methods, spontaneous financing, factoring. Yeah.
X is better.
I can't guarantee anything, guys. You know, you need to come ready for the whole syllabus. It's very important that you answer all the questions, because if I have to sometimes mark, and if I really want to give you a couple of marks and help you cross this important barrier of 60 marks, if you haven't answered a question and if the answer paper is completely blank, then I cannot even consider giving you marks. Yeah. Got it? Right. What else, guys? What else you need to know about the exam?
Only thing left to answer is the question itself.
Good. So on the day of the exam, as usual, somebody would come with the papers, and then they will go back with the answer script. Now, I did not get the reports. Now, Ranil, how do I collect the reports? Now, I gave this, what do I call, the assignment, and I gave the deadline as 4th of Jan. To date, I haven't received your reports. Sorry, your mic is on mute, I think. Ranil's mic is on mute.
Yeah, sorry. They were uploaded on the portal, isn't it?
I haven't got it.
No, what we did was we also emailed you up subsequently. Like I know from group 5 we emailed you.
Yeah, but not everybody did that. So I will I will ask Ranapura how to get that. I haven't got it yet. I also didn't follow up. Maybe it's my fault, but I haven't got it yet. Anyway, there can't be much there. No, I mean, you are 38 people, 5 in a group tops. So about 5-6 reports maximum. I think.
Yeah, 6 groups.
6 groups, yeah.
So you should have
I
had.
will ask Ranapura.
I think from our group, maybe we would have missed out to send you on email, but it is already uploaded.
The PDF file
Sure.
was uploaded.
Sure. I will ask Ranapura to send it to me.
So what happened was there was only one link to upload the file. So our PDF version was uploaded, but certain supporting calculations on Excel, etc., was added on when we emailed as a support for the report.
Right. Okay. But others didn't email. I think only your group emailed me. Right. I'll follow that up. Anything else, guys? Yeah. So if there are no further questions, I'm going to sign off. If you do have any questions, just write to me on my usual email address. I will get back to you. All good. So guys, all the very best for your exams. Please write well. Don't let me down. Because I will mark your answer scripts with passion, and I'm sure all of you all will do very well. And so I'll hope to see you very soon.
Yeah.
I'm signing off.
Thank you very much. Thank you very much for all the support, and like to see you for electives here.
Sure. My pleasure. I'll see you all soon. Thank you.
Thank you very much.
Thank you.
All right.
Hmm?